Moving on now to the retail market snapshot. We'll discuss the leasing trends, look at large format shopping centre and the CBD, and then we'll also have the tenant perspective at the end.
Okay, so large format retailing has performed well since COVID, and with new developments limited, we are seeing vacancy continue to decrease, which is leading to an increase in face rents and lowering of incentives. Shopping centres is a similar story. So again, we're seeing vacancy decrease, and landlords are therefore upping face rents and decreasing the incentives on offer. Vacancy in neighbourhood centres remains static as it does in the CBD, where retail is still struggling due to lower office occupancy. Rent reviews are up across all sectors, and the outlook is for this to continue. Retail rent reviews are typically based on a CPI plus percentage basis, and yesterday's figures had a national rate of 7.3%. I'll pass over to Adrian now for his advice to retailers.
Thanks, Gillian. So as Ken highlighted with the barometers, from a retail perspective, the leasing norms for retail remain generally unfriendly due to the power and market coverage that landlords hold as a collective over retail tenants, as well as restriction within relevant state retail leasing acts. With the market conditions, they're quite varied over the different types of retail, with CBD currently being a tenant-friendly market, while shopping centres and larger format retails are mostly unfriendly. If we look at large format retail, so the leasing market is active at the moment with a number of brands looking to grow, for example, baby and household category retailers. The increased demand for household goods has underpinned by working from home is really driving this growth. Face rents are increasing in stronger homemaker centres. A recent example that we encountered was a rent that was quoted 2 months ago, which has now increased by 40% due to higher levels of inquiries and interest. Incentives on renewals are now very difficult to achieve and only really available for new sites. Currently, our large format retail clients are looking at both new opportunities and current sites from a portfolio perspective, with careful consideration and decision making based on using informed data. This ensures that new sites or new stores fit within the current network and don't cannibalise current stores, as well as considering opportunities to relocate current stores to superior locations, both with an end in mind to provide the greatest return for both the individual stores and the portfolio in general. Moving on to shopping centres. The shopping centres are showing signs of recovery with, as Gillian said, with lower vacancies and an increase in foot traffic, especially in the regional and sub-regional centres. During the pandemic, shopping centres were prepared to provide short-term leases with lower rent increases and minimal lessee works. Again, especially in the regional and sub-regional centres, landlords are now pushing for longer-term renewals with lessee work provisions. The rate of inflation is really influencing how customers shop, with a reduction of spend on non-essential products, customers researching product pricing more, and an increased awareness of sales, cheaper products, brands and stores. This plus the new norm of online shopping is having a negative effect on bricks and mortar turnover, with occupancy cost ratios increasing. Shopping centre landlords must take this into account when setting rental levels, otherwise this will lead to increased closures and vacancies. In the CBD and fringe market, you'll see that there's a quote there, and Ken touched on it as well, around the reduction of office workers really in the CBD, and this has had a major effect on how CBD retail is faring. So it's really still has a link to that slow return of office workers. And speaking with some of the major landlords, they still believe that the CBD is predicted to remain in distress until late 2023, early 2024. Low occupancy in the CBD on Fridays and Mondays especially are severely affecting tenants, especially in the food industry. CBD landlords are now needing to provide more flexibility to attract tenants, for example, short-term leases and turnover-based rents. This effect on the CBD, on the food industry, is looking at a shift now to more food and beverage tenants looking to open in suburban fringe markets due to customers wanting to spend their money and time closer to home. So just onto the tenant's perspective, overall there is a lot of uncertainty from tenants in most retail markets due to the rise in inflation and interest rates, which is affecting the reduction in non-essential retail spending. Even though the COVID legislation period has come to an end, we're still regularly encountering situations where landlords are taking advantage of tenants and not meeting their obligations under the lease. As a tenant, it is important to understand your lease and include provisions for penalties against landlords for non-performance or inaction. The pandemic has provided an opportunity to change the rules of the game when it comes to lease arrangements. It's very difficult to implement change when landlords hold so much power, and no doubt it is challenging out there. However, landlords must be prepared to enter into a shared risk and reward arrangement with greater flexibility provided to deal with impaired or interrupted utilisation. As Ken touched on as well, time is still the most important leverage for SME retailers. Getting on the front foot with landlords 12 to 24 months before lease expiry and not being on the defensive is vital if you're wanting to influence the outcome of the lease you deserve. Being informed and providing landlords with data like turnover details, foot traffic, moving annual turnover to support negotiation is vital in deflecting unsubstantiated and unrealistic lease terms from landlords.